Good evening, Facebook and YouTube. It is Sterling here from Day Trading Forex Live. This video, what we're going to cover is an exact framework that you can use as a directional bias guide or as a guide to defining directional bias on the day. As any of you guys know, when it comes to trading, obviously, if you're short when the market is long biased, you're going to have a rough day. If you're long when the market's short biased, again, you're going to have a rough day. So what this does is this gives you an exact framework to work within, because a lot of times trend analysis is very broad, higher highs, higher lows. Well, for how long, what period of time, and many other metrics that you can use. So this, again, it gives that exact framework, which I've found in 10 years of running Day Trading Forex Live, teaching other traders. The more mechanical you can be, especially in the beginning, I'm not necessarily recommending that as the whole way you want to be in your trading, but especially in the beginning, that's an important factor. So that's what we'll do here. We'll get into what I term as market cycle. And this is important, and it works well because the market cycle, or the market, tends to trend maybe 30% of the time. The majority of the time, the market is sitting in a relatively tight range, or not necessarily a tight range, but a range nonetheless. So the majority of the time you're sitting in a range, which dictates that our trend strategy, or something we use to analyze the trend, should really account for that. And this does kind of by default. We'll get more into that as we go. Feel free to ask any questions. That's what I always say as we start this video. I'll glance every now and then at the chat, see who's asking any questions, if you have any. And then at the end, I'll definitely do some Q&A as well. So let's get started with just some basics. Again, we term it as market cycle. That's the basic terminology we use for this. And what is market cycle? Well, basically, market cycle is what we just discussed. It's a way of defining trends. So how do you define a downtrend? How do you define an upward trend? What this does is this short term, really over the course of, which we'll get into here in a second, 3 to 5 days, but that being just your rough figure, it's a shorter term directional bias. So what it's good for is defining that, and then number two, defining when you've gone into a range, which is really critical, because when you're coming out of a trend, you need to know you're coming out of that trend, or at least the possibility is higher that you are at that point. So where do we look for this? Well, mainly I look for this on the 1 hour chart is what I find it tends to be the easiest. But the fact is, and you'll see this as we discuss it, you don't need a certain time frame. You could technically see market cycle on a 15-minute chart. You could see it on an hourly chart. You go beyond the hourly chart and it starts to get a little bit fuzzy, because you're looking at such a large chunk of the day within one candle. So I recommend the 1 hour when identifying market cycle, and you could be on the 15-minute as well. That's a possibility. So you'll see why it's not a huge difference. When? Well, for me, market cycle, I look at that because you have to, if we're putting metrics to this, which again is important in that learning process. If you're putting metrics to this, when it comes to when, we look at cycle as a 24-hour or during a 24-hour period of time. What that means is that the day starts at 5 p.m. So in the world of trading, the day starts at 5 p.m., the day ends at 5 p.m. You go through the Asian session, you get into the European session, the London market opens, the New York market opens, and the New York market closes at 5 p.m. again, with the next day starting at 5 p.m. going into Asia again. So what I look at is that 24-hour period of time, again, 5 p.m. to 5 p.m., and that is based on Eastern time. So if you're not sure what Eastern time is, just go to Google, type in world clock, and look at what time it is in New York. That'll give you Eastern time, and pretty straightforward to pull up. If you can't pull up the time, you got some bigger issues going on. So pretty straightforward there, 5 p.m. to 5 p.m. Within that period of time, that's how I'm going to define one push within this market cycle. That will make a bit more sense as well. Now we're going to get into how, and there's really 3 key steps. So that is what the gist of this video is going to be about, getting into those 3 steps, kind of breaking market cycle down. So I'd encourage you, if you want to write down rules, get a pen and paper, start writing some stuff down, and ask questions where you have them. Let me know where you guys are listening from. Always interested to hear. Feel free to leave that in a comment. See where you guys are from. But anyways, number one, we'll start with market cycle rules. Number one is what is the totality of a cycle? Well, essentially a completed cycle is made up of 3 individual pushes. So an individual push being in one 24-hour period of time. Does it move within that 24-hour period of time at least 90% of the ADR? Now, if you don't know what ADR stands for, it stands for average daily range. You can see here I have ADR plus. So it could be further than it could be further than 90% of the ADR. It could be, 100%, 110, 150%. There's some other rules when you get up around 2 times the ADR where I start to cancel cycle. But in general, until you get to about 2 times ADR, as long as you're over 90%, I'll consider that a valid push within the context. Again, context is key with this, which we'll talk about as well. So 3 individual cycles of 90% of the ADR or more. One of those pushes or one of those cycles can occur within one 24-hour period of time. You cannot have a first push and a second push within one day. One push, one day, that's it. And I'll provide some examples of this as well, and there's a ton of other videos on the site that kind of walk through this process as well. But number 2 is the time. So this is important when it comes to time because the fact is you could get 3 pushes in one direction over the course of 20 days. I mean, maybe the market goes sideways for 8 days. Look at what the dollar yen did. The dollar Swiss, actually, I think it was dollar Swiss, went range bound for 8 days, a really tight range. So you could have the market make a push, stall for a very long period of time. So you have to put a time limit on it. And what I've found over this period of time, and really this has been a refining process, people ask me where this comes from, just to go into kind of a basic idea, which I probably should have covered first, and that is the idea of 3 cycles, the idea of 3 pushes in the market is not something new to DTFL. It's something that's also not specific to the Forex market. If you look at, say, the equity market, there's a general rule in equities, you get 3 days in a row to the upside. The 4th day, well, you should typically watch out for that, especially if it was running on news or there was some type of catalyst to drive it up aggressively for 3 days. That 4th day tends to be a turning point more often than not. And a lot of ideas in the market going back literally well over 100 years ago go back to the idea of 3 cycles, 3 pushes, 3 waves in this direction. Now, for me, I apply it very differently in regards to that, and it's a different kind of mechanical rule set around it. But the idea of the market moving in 3 waves, 3 pushes, 3 cycles to one side or the other is not something new to DTFL. It's just something the market tends to do, and it tends to be pervasive across across all markets, and it's something you'll just see frequently. So I look for this move of this entire cycle, a completed cycle, which would be 3 pushes of 90% of the ADR or more. I look for that to occur over 3 to 5 days. So what that looks like is the market could go, and here's another rule that goes along with this, we don't allow 2 days of sideways price action. So if the market does not continue the cycle, as an example, let's say it gives a first push up, and then you go sideways for 2 days. 2 days of sideways price action cancels the cycle. So how do you get to 5 days? Well, you have first push up, second day sideways. 3rd day, you get your second push up. The 4th day, you could go sideways again. That's 2 days going sideways, but they're not 2 consecutive days. And then on the 5th day, you could get that 3rd cycle. So I could draw that out on the next screen as well if that doesn't make sense. But 3 to 5 days, days are measured again, 5 p.m. to 5 p.m. market time, as that's what matters for us. Now the final rule is an overall length rule. The final rule, being an overall length rule, it just gives you a guideline of where this thing could potentially end up. I'm not trying to front run that necessarily. It's not how I trade personally, but it gives you a rough idea of, hey, is this thing complete? And as a good base rule, 2 times ADR is just a great starting point for that. I'm a firm believer that complexity kills repeatability. And if something isn't repeatable, you got to do this for a decade. the profit you make in a day, in a month, even in a year is not going to define whether you're a successful trader. You got to do this for the long haul. So what this does, this gives a very basic guideline that's easy to follow. It's consistent, it's repeatable, and it gives you a good overall length for this move. Now, like we talked about a little bit in the beginning, the market goes sideways, 70% of the time. So a lot of times you're going to be coming to an end on this cycle and you don't necessarily have a start to another cycle. It's important to keep in mind that 50, maybe 60% of the time I trade actually without a directional bias. And that is, that's logical. The market moves in a range 70% of the time. Now, if it's in a range and I'm looking for the market to break higher, set consecutively higher highs and start trending to the upside, or vice versa, start moving down when the market is and has been range bound, that's a situation where you're not in an optimal situation, to say the least, I guess. Best case you'd hope for there is maybe a no trade. So the idea of this strategy is really, here's your base idea. Now we got to start applying it to the chart, because for me, especially with market cycle as well, market cycle is a filter. When it comes to our entries, and this is what I was going to talk about a little bit earlier, when it comes to our entries, we start with number one, market cycle, identify directional bias. But the next thing that we need is we identify then a manipulation point. If we have a directional bias, the manipulation point would be for a trade in only that direction. And then we look for what we term as a confirming entry. I've covered the confirming entry in the last live video, as well as the selection of manipulation points. Those are videos I've done recently. And this is really the first point in that step, or the first thing you look for in that process. But, and this is the key, cycle is a filter. Cycle is just a filter, like, I'm sure you guys have filters in your trading, different things you look for to, filter out whatever it might be. Maybe for a better entry, you get this type of setup, or whatever it happens to be. You use filters for an entry. So when we look at this, again, keeping in mind it's just a filter, or keeping with that in mind, I should say, it's possible that we trade without it. And like I said earlier, probably 50 to 60% of the time when I do a daily market preview, and for those of you guys that don't know, every night I do a video for the daytradingforexlive.com members, where we break down the directional bias here on the actual chart, as well as pre-select the manipulation points. But a lot of days going into the next day, probably, if you're a member and you're looking back through the years worth of daily market previews that are there, you'll probably see 50, 60% of the time we trade without a directional bias. So that is key, because again, the market doesn't tend to trend the majority of the time. So knowing how to apply these rules is really critical. And that's where something that I call, or some basic word here, context, that's the word that I use. And what do I mean when I talk about context? And actually, let me take a quick look here, grab a drink and take a quick look at the questions. Melbourne, Georgia, well, quite a range there. Norway, from all over. Spent the day on your website. Hang on, guys, got a cough. Let me mute this thing. I mean, the strategy when it comes to the method we use, are you talking more about your short-term setup I refer to, or the confirming entry? Because with that, it's all, it's all a whole process, not just the confirming entry necessarily. But I'll touch more on that here at the end. Let's go through context a little bit, give you guys a little more info on, what this actually might look like in the real world. And obviously, I'm trying to cover something that, it's just like I always explain. When I learned to fly an airplane, you go through a ton of written material. I went through a crap ton of written material, but no matter, and I even went through videos. There's a great course. Anybody that wants to learn to fly, there's a great company called m0a.com. They have an awesome online education that I purchased as well. But you can't learn to do that with just a video. You can't learn to do that with text. That's why I say, regardless of who somebody chooses to learn from, make sure that there's not just a course. Make sure there's an application phase where there's somebody, like what I do with the members, where I'm showing them how to do it on a daily basis, where they know when I take a loss, they know there's no way to spin that when you've pre-selected the level and the entry's mechanical. If I take a loss, I took a loss. If I have a profitable trade, I have a profitable trade. So unless you're seeing it applied like that, it's really hard to learn these rules. So this is kind of just your basic layout, but getting the context, which we're going to cover, is critical. So what do I mean by context? Well, there's a few things you can use that are very easy we're going to cover here, and that is, one of them is a shift in bias. So when you've been moving to the upside, maybe you got a couple days like this, but maybe there's no cycle through here, because the market can be moving directionally and we don't have a cycle. Maybe none of these are 90% of the ADR. Maybe they're only 50%, and then 55. Maybe nowhere near 90% of the ADR. I will make accommodations sometimes, but let's say it's, again, missing big time. Well, if that's the case, and then I get one of these, let's just say it's 100% of the ADR, it makes for a very clear illustration that that's a first push. Number one, it makes for a clear illustration that it has to be, and this is just through process of elimination. What I recommend starting with is, with cycle, is either up, down, sideways. That's as basic as you can get. Up, down, sideways. Up, down, sideways, and once you have up or down, if you have sideways, obviously we go to a directional bias, and then we just look at our manipulation points both above and below the price to go long from, above the price to short from. But when we're talking about this here specifically, in regards to context, I guess the main point I want to convey is that if you're going up, down, sideways, that's your main base starting point. And then the next thing you're going into is, if you, again, determine up or down on the directional bias, it's either first, second, or third push. So in this situation here, is it possible that you had, based on the mechanical rules, is it possible that you had a downward cycle prior to this day? And let's say, again, one cycle, 1 day, so 1 day, 2 days, 3 days, 4 days. This would have been the 5th day. So is it possible that there was a downward cycle if the market's been moving up? Well, based on the mechanical rules, that's not possible. So when you get a full ADR length down, you ask yourself up, down, sideways. Well, it's not sideways. You had a full ADR length push down. It's not up. You got one answer left. That's a downward moving market. Then you ask your next question, up first, second, or third push. Is it first, second, or third? Well, do you have a first push prior to that? And if it's not that clear, and this is such a key, because cycle is a filter, and I'm totally okay trading without it. I'm almost prefer trading without cycle, to be honest with you, because it offers more opportunity. It offers opportunity whether the market's going up, whether the market's going down. But in this case here, if it's not that clear where you're like, okay, that's a clear shift in direction, again, that shift is the key to why you're able to identify that. The other option is something like this. The market maybe goes sideways for a day, maybe that's a 30 pip range or whatever, and then you come sideways for another day, maybe a 40 pip range. Bottom line is, you have 2 days of sideways price action. Remember we were talking earlier about 5-day completed cycle. Well, one of the rules with cycle that'll cancel cycle is you go sideways for 2 days in a row without giving the expected second or the third push, whatever you're looking for. Cycle goes sideways. So I didn't even need this 3rd day, but I just threw it on there. And after 2 days, you've now gone into an open bias situation. That means that from then on, you're looking to, for the next day, let's say that day closed. For the next day, I'd say, okay, no cycle at this point. We've gone sideways for 2 days, so it doesn't matter what the market was doing prior to that 2 days. Very mechanical idea right there. And that's important because it's just easier to learn. It's easier to learn, and it's going to teach you the discipline of following a rule set. There's a lot of really good to that. But anyways, when it comes to this, you go on sideways for 2 days, I'm going to select upper manipulation points from which I'd be looking to get short from if we came into it, created the stop run, confirmed down, or I'd be selecting lower points for the exact opposite, to look for the market to come into, create a stop run long, and go long from that point. But either way, that 2 days gives you a canceled cycle. That's when you go into an open bias. And the beauty of this as well is that when you come out of that range, when you come out of a very clear range, it makes it much easier to identify. When you have something that is, let's call that 110%, or just illustrating clearly that it broke, or that it was a full ADR length push, 90% of the ADR larger. But the point being is that in this case, when you've gone sideways for those multiple days, when you finally do break out of that, it's just much easier to identify, and it'll, especially with the metric of is it moving 90% of the ADR, it's going to give you an exact idea for where we'd be at in market cycle. Okay. All right, guys. Well, I think that's probably going to wrap it up for my part, unless you guys had any questions. We've got about, at least from the video I can see, we've probably got about 5-10 seconds of lag, so I might have to pause here for just a second. But yeah, here's your basic idea, basic rule set with that. Now the key with cycle, a couple other keys, I guess I'll put a couple other keys with this while you guys write any questions if you do have any, is that when I'm looking for the second push the next day, and I'm going to use this example here, but if we had a full ADR length push down, I would then look for, the market's likely going to give a little retracement, go sideways through Asia, and then what I'd look for is I would look for the market to move up into a pre-selected manipulation point. That's what we select in the preview each night. We're selecting the exact point we're going to look for the stop run from. And then I would look for that to move down. But when it comes to selecting that manipulation point the next day, it's a specific range that I look in, and that is the 25 to 65% retracement. So, somewhere in this range, obviously, you can get some exact figures on that when you're measuring. But the simple point here is I look for the manipulation point to be at least 25% retracement, and I measure wick to wick, so wick to wick, at least on a 25% retracement, and at most 65. The reason behind that is again, nearly 14 years of trading and just experience knowing where the market's going to hold, if it's going to hold. So you have to have a minimum point in my experience, because markets typically retrace. That's the norm. So I'm going to follow what the norm is. The second point is you have to have some point at which you say that this thing is no longer a retracement, and now this is likely a reversal. So you have to have some cutoff for that, and I use 65% as the cutoff. Like I always say when people when they ask me about that number, well, why 65? Why can I use 70? Can I use 60? Guys, the biggest struggle to you being a profitable trader is being able to follow a damn plan for 10 trades in a row. It's like the other video I talked about when I talked about the 20 trade challenge. And if anybody goes through the trading plan, what you're going, or your track record of trades, what you're going to see is you're going to see maybe one trade that follows the plan, maybe second trade follows the plan. And 80% of people don't even have a plan. So I'm talking a written plan. So then I'm only talking about a small percentage. And that small percentage will trade the plan until something goes wrong. And once something goes wrong, that's when the revenge trade comes, the over trading comes, the double down, quadruple trade, the anything else that goes along with it. The boredom trade, the whatever trade you can think of to self-destruct. And I don't say that based on anything other than personal, very first-hand, repeated, in-my-face experience. So I can promise you're going to be the biggest hurdle to becoming a successful trader, and keeping yourself from doing that, because no matter how good your strategy is, let's say you have the best strategy in the world, every strategy will have losses and drawdowns. So if somebody cannot maintain mentally through a drawdown, if they can't at any point in their trading account history, they don't have 20 trades in a row with no in-between revenge trades, over trades, anything else. If you don't have at least 20, and that's just a start. I mean, that's a base starting point. I even say, hey, lower it to 10 sometimes. And you'll be surprised that it's just a very self-reflective type exercise. It forces you to see something that most people really don't want to see. And I get it. It's way easier to blame the broker or the educator or whatever it might be. It's way easier. I get it. But the fact is, until a plan can be followed, until number one, you have the plan, and number two, until you're following it, none of this really matters, because these are all guidelines that you can break very easily. You can do whatever you want. Okay, let's see here. So basically, if it goes sideways for 2 or more days, is the cycle count start fresh? Yes, that is it. If you have 2 days of sideways price action, that's one way to draw context from the market and say, okay, based on this occurring, we've canceled cycle. Like anything mechanical, it has positives and negatives because of choosing to do it mechanically. This has the positive of giving people structure, and it gives you a very good idea of when to look for a start to a new cycle. And in the decade plus I've been doing this specific thing, that's been my experience. It's been the best route to do that on 2 days rather than 3 or 1. Another thing about context, guys, is, let's say you get 3 very clear cycles to the upside. Well, the possibility or the probability of that range becomes significantly higher, at least for a day or two. So there's other ways you can use it. There's other application. There's a lot of other kind of little nuances to it. And like I said before, I'm a firm believer that you need to see something again and again. I would encourage you at the very least to check out a lot of videos on the site that cover this. Below this video, I'll link to a 3-part series I did years back, but it's a really good series. Quite frankly, it doesn't matter whether I produce the information today or 5 years ago, because this strategy doesn't change. This strategy is basic market function, guys. I mean, this is core market function. So when you're talking about change, it just doesn't really change. This is how we kind of, and I'm not necessarily talking about the cycle as core market structure, just to be totally clear about that. I'm more talking about supply and demand and the fact that we look for manipulation points around high liquidity areas, along with this, this is the one part of the strategy that I would not consider basic market function. It is, but it isn't. I talked a little bit about that earlier, but not really important necessarily. So I think I'm going to wrap it up here, guys. Question on indicators. Do you recommend using indicators like quarters theory? I've personally never seen an indicator that remains profitable over an extended period of time. But the other side to that is the best traders, and I guess the other side is the best traders I know that I know personally are all mechanical traders. They don't all trade the same thing. There's a long-term price action guys, a couple of those guys I know are profitable. Trader Dale is one of the guys I talk about. He's another educator that I really like. He teaches volume profile. He's also a very good trader. So they're all based on market price action and reading price, reading volume, reading, real core things. Not indicators just are very superficial and they lag. So it's kind of, make sure you go over that reactive versus predictive video I did. It's an awesome video. It talks about how, like with all indicators, a rising market, and this can be different with different indicators, different indicators are not necessarily functioning like that. So based on your specific indicator, you're going to need to analyze that. It's just, in my experience, the best, most profitable traders I know are mechanical traders that they use EAs maybe for assistance on money management just because they're not there, but for the most part, they're looking at price action, they're looking at basic volume ideas and things along that line, and that's just been my experience. All right, guys, that's going to wrap it up. I hope you enjoyed the video, and I'm not sure what the next one will be. If you have any suggestions, you have different aspects of the strategy that maybe you have questions about, things I haven't covered, things you want me to cover. I did just put out a video on a live trade that I took. I took it right there. I also show you my order entry, everything like that. And I'd encourage you to check that out as well. It's a cool example of how you can trade market manipulation around news and short-term market manipulation, how we do that. So another interesting video that you'll find if you're on Facebook or YouTube, or if you're on the site, you'll find it as well under the FX blog, also the recent trade section, or on the front page of the site. It's the very first video. All right, guys, I'm going to quit running my mouth here. I'll see you all back for the next one. Until then, happy trading.